Good evening, ladies and gentlemen. Welcome to a running behind late Rates and Lanes podcast. I apologize. It's totally my fault. Lost track of time, and shipper was taking their time loading us, and we was trying to rush to get back. But we are here. We ride again on the Rates and Lanes podcast tonight. Our resident, I'm affectionately calling him our resident freight analyst. We have the lead analyst from DAT joining us tonight, Mr. Dean Crooke, and it's always a blast whenever we have Dean on. Always a wealth of information and knowledge. And so just a little bit of housekeeping before I bring everybody up. Please help us like, share, and subscribe to the channel. Hit the little bell icon. It doesn't cost you a thing, but it helps us out tremendously. So if you would, please do those things for us. And I think that's just about everything. Let me welcome my co-host in real quickly, and we'll get Dean up here. Good evening, Chuck. How are you?
We're doing great. I'm looking forward to tonight's show. I always love having Dean Crooke on. He knows so much, and his analytics are second to none. So with no further ado, let's get him on here.
Yeah. I'm running behind, so we don't want to miss out on any information. So Dean, good evening. Thank you for being patient with us, and thank you for joining us. How are you this evening, my friend?
Yeah, good. Great to be with you guys.
Great to have you.
I love the show. I always look forward to Chuck's promo material. Today he was bench pressing 1,000 pounds.
Dan lifted 305 today,
Oh, it was almost like
I say Chuck getting it
in.
Rico, it was almost like he had the whole axle on the back of the truck lifting up there on those things. You could see him in the shop fixing his own trucks.
Chuck's a regular strong man around these parts.
Working at it. I hear there's a lot of money to be made in the NFL. That's what I'm working towards. Now that Brady's retired, I have a chance.
Yeah, my home team, the Patriots, aren't doing so good, are they?
We don't even want to talk about teams that's not doing good, because my team absolutely is a dumpster fire. I tell you, we firing head coaches 1 year in, and oh man, it's tough to be a Carolina Panther fan right now. Goodness.
Wow. Yeah.
Well, there's lots going on in the trucking industry. It doesn't stop.
Yeah, it's these are like really
interesting
times, really difficult times. So there's not a lot of good news other than diesel prices are dropping. That's about the only good news.
Well, you know what? That is great news for a lot of our listeners that are still in the spot market who aren't getting the fuel surcharge.
Exactly. Yeah, it's diesel's been dropping fairly consistently over the last 4 or 5 weeks. It's down to $4.21. So that's, it's still about a third of operating costs for our long haul carriers in the spot market. So when you look at where rates are, though, we're still around break even for the typical carrier. Things still aren't all that good from an operating profit perspective. And Chuck, Rico, not a lot of good news on the horizon. Like, this is a really bad peak season for those carriers in the spot market, different for dedicated contract carriers, but spot market rates have been pretty much flat.
It's terrible.
Take out fuel, they've been flat for almost 2 months. Like, that's
it's terrible.
Yeah, and
do you think, in your guesstimate, would you think that's going to stay that way?
Yeah, Chuck. I can't remember if I said it on this show, but I said about the third of the way through this year that I sort of said rates will end pretty much flat this year where they were back then, and that's pretty much how they're going to play out. Probably around $1.60 a mile, excluding fuel. That's not, that's probably going to be a little bit above where we were in 2019. When I look at the top 5 states, right, for spot market volume, California, Texas, Illinois, Georgia, New Jersey, they represent probably about a quarter of the spot market volume. The average line haul rate in those markets is only about 5 cents a mile higher than this time in 2019. So if you said, how bad is it? 2019 wasn't a great year for carriers.
It's a horrible year.
And brokers. Shippers, of course, were probably pretty happy, as they are now. but it was a bad year for carriers. And of course, though, what makes it horrible now is our operating costs are much higher.
Well, that's the big thing is, the operating costs of since 2020 have skyrocketed. You look at the cost of tires or the cost of repairs or the cost of replacement vehicles, tools, you name it. Everything has skyrocketed, and we're working for the same amount of money.
Yeah, it's interesting. I've been watching a few people on social media over the last year, and just this week, a guy that I know that parks his truck down near me, and he's been running a flatbed for probably a decade. Beautiful big Freightliner Cascadia and smart operation. This weekend, trailers gone and for sale signs up in the windows, and then and another guy that, not surprisingly, I watched. He must have spent $300,000 on this 389 Peterbilt, tricked it out. And I watched him. It made a big news on social media, big splash on social media out on the West Coast. And I thought to myself, how are you going to make money hauling flatbed? When he started this, he started it just as the whole market was starting to wind down. Next thing, he's under an Amazon Prime trailer. And next thing, last week, the for sale sign pops up on social media, and I just see it more and more where carriers are really struggling. And we lost about 13,500 carriers in October. That has slowed right down. We've only lost about 8,500 so far this month, and we've still got a couple of days to go. So October was a really bad month for carriers leaving the industry. And that follows the pattern that I've seen over the last 2 years. As soon as diesel goes up, within about 8 weeks, the cash flow crunch hits and carriers leave. I saw it in late 2021 when diesel started to go north of 350. I saw it when Russia invaded the Ukraine. I saw it when diesel hit 580 last summer. And I saw it again just after July 4, just gone, when diesel went up 80 cents a gallon in about 6 weeks. That's when October saw the carriers sort of go out of the industry. So there's definitely a strong connection between diesel prices surging and carriers suffering within about 8 weeks from, just that cash flow crunch of not being able to pay the higher fuel bills as rates have been dropping. And I think, Rico, I'd love your opinion on this because, I always knew that if I could have predictable operating costs, I could figure out pretty much how to make money and stay in business. But with diesel being such a roller coaster ride for spot market carriers, I can see it being almost impossible to maintain profitability if you don't know where diesel's going. Like 1 month it could be up 40 cents, the next down.
Diesel is just a part of the equation, though, Dean. The thing that hits most owner operators, single guys especially, that hits them hard and hits them in between the eyes is the unexpected breakdowns, the unexpected major breakdowns that the ones that you're not necessarily anticipating. You may have a little bit of a nest egg put back to address one breakdown, but at least it's been my experience. The thing that I have had to struggle with is when I have had the unexpected. I have the money set aside for expected maintenance expenses, but then as soon after I have, say for instance, if I replace 8 of the drive tires, if you're going with a decent set of Michelins or something like that, that can easily run you in the neighborhood about $4,000 or $5,000 to replace eight of those tires. Well, if you just outlaid that much money and then you turn around and have an unexpected breakdown, and then you got the cost of the parts, the labor, and the downtime, all 3 of those things that are hitting you, coupled with the diesel. So it's like you're getting hit from every angle, and that's the thing that most people is having difficult to recover from. Is getting hit with all of those things back to back to back, because excuse my language, but you start to feel like a one-legged man in the ass kicking contest.
I see some of the comments dropping in there. I think we've touched the nerve here because, and maybe I could just give some people a little bit of glimmer of hope. The killer combo. If on our short-term 35-day forecast that DAT has, now remember we're forecasting out based on seasonality, what we see typically year to year, and what some of the more recent trends are. Between now and the end of the year, if rates are at $1.63 this week, excluding fuel, we strip fuel out, so add 50 cents in for the fuel surcharge to get the all-in.
Right.
So with the all-in, you're up, north of $2. Rates have. I'm just looking at the forecast now. Rates are forecast to end just after Christmas at about $1.80. So they've got 17 cents a mile more to increase between now and the end of the year with dry van. So for those that are sort of, these are national averages. I acknowledge that. And there are some lower rates coming out of some other markets like Seattle, but much better rates coming out of other markets where there's a shortage of trucks. So, treat the averages as you will, but that rates will definitely improve between now and the end of the year for dry van. Refrigerated we're about $2 now. They'll go to about $2.15, right? So there's roughly the same. And flatbed, sitting at about $1.90, probably will go to about $2. So flatbed's not got a lot of room to go.
And see, that's the tough part,
Yep.
Dean. With that I think that a lot of people is the bewilderment that a lot of people are experiencing is that, man, we running for rates that we was doing these rates 10 years ago.
That's right. And look at how much costs have gone up. Look at the cost of replacing equipment alone. It's insane to try to do this at rates that you were paid 10 years ago. I have news for you guys. We got this 30 years ago.
Yeah.
Yeah. I was being generous with 10, but you're absolutely right.
We just got
and I think that the thing about it is that I think that I was going to ask you, Dean, you was talking about the carriers that are going out of business, that are shutting down, but what about the replacements? How many new carriers are coming in? Because I think the biggest hindrance that we're having with being able to push rates back up is that we got people that are still running for, it's a race to the bottom at these rates. But somebody's moving the freight, obviously, because they haven't moved. It's not a thing. It's not a sense of brokers depressing the market. It's just a sense of, hey, they can get it moved for those rates.
Well, because it's a free market. That's why.
Exactly.
There are people that are willing to move it for $1. If you have a bunch of trucks stuck in Oklahoma or in Texas, and the market all of a sudden sees that there's 100 trucks there and there's 3 loads, those loads will move for $1.20 a mile.
Yeah. This is the challenge. I'm sort of watching the comments out of the corner of my eye here, and there's no question you can't make money with new trucks at $1.50 a mile, and costs have gone up. But the real problem, Rico, you touched on it, and I'm just looking at the numbers right now. There's a few things going on. We're at the bottom of this freight market cycle. They normally last around 20 to 23 months in duration, right? So we're right around 20 months into this current one, and we're at the bottom of this freight market. Now, we're at the bottom of the market for brokers also. I know a lot of carriers, get antsy when we talk about brokers. Broker margins are compressed as low as they can go also, right? And they're looking to buy capacity cheaper. So, when rates drop like this at the bottom of the market, this is why you're seeing a lot of brokers really struggle, because their margins have been compressed also.
Right.
So
yes.
this part of the market cycle is very predictable. It happens every time. The challenge we've got right now is this one's dragging on. Normally in peak shipping season, we'd have seen higher freight volumes and we'd be off to the races and things would be getting much better. That's not happening this market cycle. It's much flatter.
I don't know if there's light at the end of the tunnel.
Well, there is, and it's not a train, Rico, but we have to let this thing, we have to live through this, and we have to live through the anxieties that come with it, and then it will turn around. It always does. We had the longest shipping boom in our history. Freight rates never in the almost 50 years I was in it, never stayed as high for so long as what they did in that last boom.
Right.
So,
Well, what I'm saying, Chuck, is that I'm not so sure that the economy it's looking from my perspective, and truly enough, this could be just this is completely anecdotal,
right.
but from that anecdotal standpoint, it seems as if the economy is not really chugging along at as the quote unquote experts say the economy's in good shape. I'm just from an anecdotal standpoint, from my viewpoint, I'm just not seeing it that way.
And Tremaine's made some really good points in the comments there. There's something that he hasn't listed there, and that is that shippers are doing a lot more dedicated freight with their own trucks. So there's a few things happening. There's less truckload volume. So the whole pie is smaller this time around, but the part of the pie that goes to the spot market is getting less, right? Historically, because if you look at some of the, if you follow the, contract freight. So look, think about contract freight in the market that's not on the spot market, 85% roughly of freight volume. Large carriers that are getting load tenders are accepting over 97% of the loads that are tendered to them by shippers.
Right.
That tells you that there's plenty of capacity in the contract market, and very little of it is falling through into the spot market because large carriers reject it. Normally, I've never seen tender rejection rates so low for so long. And what that tells me is that contract rates are still reasonably good for those carriers.
Right. And they're getting a few surcharge.
Right. But and they're what they've done is they've reduced their capacity. I looked at the Journal of Commerce Truckload Carrier Index today, which is an index that measures the number of trucks in public transport companies at the end of each quarter. Right. And they've been doing it since 2006. So they benchmarked it at the end of the quarter 4 in 2006 when the trucking economy was really strong here. And they said that was 100%, right? Q4 06. End of Q3 just gone, it was 89%. So we got less capacity than we did in 2006. But more importantly, the amount of capacity in large truckload carriers, who are sort of the ones that the large shippers send all their volume with,
right.
End of last quarter was the same as it was at the end of the quarter when the pandemic hit. Right? So what they've done is they're shrinking their capacity also.
Of course.
They're not hiring as many drivers. They're probably trading more of the older trucks in to keep a lid on things.
Yeah.
So you're seeing the contract market stabilize, I think return to more normal levels. It's very flat because, to your point, Rico, manufacturing is down about 2% in terms of production volume. That drives a lot of things that we haul. And Tremaine's other point that I think he was alluding to is that as consumers, we've shifted away from physical goods that we bought more of during the pandemic, and we've shifted back to a more balanced goods and services. Right. So during the pandemic, we spent less on services because we were at home. We consumed more physical goods that trucks put on their backs. Since things have stabilized in the last year, we've gone back, I think, spending probably a little bit more on services, holidays, vacations, hotels, restaurants, and less on physical goods. So that's the other part of why we're seeing less demand, is that the change in the economy. We're seeing, Tremaine made a good point there about LTO carriers building their own network, shippers also building their own networks and their own load boards and their own dedicated fleets. So I think there's just less. And then on top of that, the doubling of truckload capacity from June of 2020 to the end of 21, we went from 250,000 to almost 450,000 long haul for hire carriers.
Good
Rico,
Lord.
You asked me
a quarter of a million.
Yeah, and we've lost about 130,000. I've got the numbers here. I could probably.
We got to lose about another 100,000 then for it to go back to normal.
Yeah. Well, so Rico touched on it, and I didn't answer it fully. But in the last year, since October, we've lost 158,000 carriers in the long haul sector. We gained 132. So, yes, and the question I should answer. So where are they going? Who are they, and what are
Well,
they
my
doing?
understanding is the 132 that have come back in, a lot of them are box vans and final mile. They're not the
You got it.
they're not the same group of people that came in,
Yep.
post pandemic.
So we're losing capacity out of the long haul, I think, freight business. And I think we're seeing carriers come back in, reactivate authorities, car haulers, dedicated drayage, all sorts of stuff is happening where the action is. But it certainly isn't in the long haul freight sector. And Tremaine kind of didn't go the full way, and I bet he would have if he would have given him enough airtime. But the other thing that's competing with long haul truckload is intermodal rail.
Yes.
That's what I was
J.B.
on.
Hunt apparently has come out with a brand new program, and apparently they're kicking ass and taking names.
Yep. Initials. They're so busy, just initials.
Yeah.
So
now, to put everybody a little bit at ease, we are in the winter, and rail cannot really compete with truck coast to coast because you have weather issues with trains that you don't with trucks.
You do. So I think this is we don't. I mean, this is tough. I think it's going to be a really hard first quarter. It always is, right? It's always the quiet season. We just still have a lot of truckload capacity in the market, and one of the other comments came in there earlier about carriers hauling cheap freight. I know carriers who are trying to finance a bill on a truck that they paid 3 times more than what it's worth now.
Right.
They have to run, get whatever they can. And then on top of that, you've got a lot of other carriers that are working on round trip rates anyway, and anything they can get on the backhaul is cream on the cake. So there's so much in the freight market because a cheap rate to one person is like a fantastic rate to another. It's such a volatile market right now.
Right.
And when I say volatile, I mean there's so much that can change in this market. Normally this time of the year, we normally see the change. It's just not there. I'll give you the data point's really interesting. So my wife's catering business, right? Normally this time of the year, they are booked week after week with private birthday parties.
Right.
This year, none. So
we don't have that extra money to spend.
Well, and she said we saw exactly the same thing in 2019.
Right.
So I think people they've changed their consuming behavior. There's a lot different freight mix. Tremaine's got a great point. We had Ibrahim Bayan on our show today talking about commercial warehousing space.
Yep.
There will be an abundance of warehousing space next year, an increase in vacancy rates, but a lot of it is being built near ports. He's exactly right. Yep. So you're seeing a shift in where freight's moved. Yes. Savannah had a lot of infrastructure built around the port there because it takes about 5 to 6 quarters for a warehouse to go from breaking ground to being operational, right? So a lot of the capacity that's coming online now was stuff that was started, quite a while ago. A lot of that is still going to come online. Ibrahim said there's about 500 million square feet of warehouse space still to come online right now that will work its way into the market next year. But long-term vacancy rates are about 6.2%. Right now, we're only at about 5%. So we're still, even though vacancy rates are there, it's not a crisis in terms of too much warehousing space. Yeah. The point is they've just been built in different locations than what you'd normally see, in particular in areas where there's lots of land, such as Fort Worth and Phoenix on the outskirts of Denver. So there's a lot that's changed in the pandemic. Since the pandemic, it broke a lot of things, but it changed, I think, how freight moves fundamentally. And the other thing that's different now is shippers are much more strategic around how they buy transportation because they've got much more data and they've got more analytical tools to figure out what they're paying at a lane level versus their peers and versus the market. That's something that's fairly new in the market. I didn't see that in the last few freight cycles, certainly not as obvious as it was now.
But they are they're getting their hands on that data and they're using it to their advantage because freight it's a huge cost for a lot of them.
So what that tells me is that if you're a carrier, you better know your costs just as well, right? You need to be as sharp as they are because normally this is a broad statement, but normally shippers were the last ones to know.
Right.
And when I worked,
Right.
when I worked at FreightWaves, and I would go into shipper locations and big associations and talk to big groups of shippers, it was like I was describing a freight market that was foreign to them, because the market they were describing was based on what large carriers had told them. And I
Right.
was coming at it from another perspective, looking at the whole industry,
Right.
spot market, all the different sectors, and saying, this market is different. And I was always shocked by how much of a gap there was between their perception of the market and reality. That has changed. When you go and talk to groups of shippers now, like we do, in our DAT world, we've got about 40 billion in contract freight spend. So it's a sizable group of Fortune 500 shippers. They are clued in on everything that's going on in the trucking market. Now, they don't think about it like we do because they make stuff. Trucking is just a small part of their portfolio, but you better bet they're aware of what they're paying at a lane level, because they got burnt in late 2018 when rates went up, and they missed some earnings calls, if you recall. A lot of people got fired. And then they really missed during the pandemic. Now, you can't fault them for that, because there was some extraordinary things happened. But a lot of shippers blew their entire transportation spend budget during the pandemic because they had to move so much of it on spot. So now they're enjoying pricing power. And the bad news for all of us is, I think, well, when I say all of us, carriers, as I put my carrier hat on, is that contract rates are still dropping. Their rate of decrease is slowing to single-digit rate decreases. But they expect that to continue well into 2024. So shippers who control the demand, the freight that we haul, they're still thinking about rates decreasing throughout 2024. They are aware, though, that the market will turn at some point. So that's why this freight cycle could be a very slow bottoming out process and then gradually increasing, because we lost 132,000 carriers and we got 126,000 back in. So there's no significant shift in capacity to change the market dynamics.
And that's what we really need, is that we need to shed that extra capacity to bring the market back to where it should be.
That's what always happens. And that's why the OPEC Plus meeting on Thursday, I think, is going to be really, really important, because OPEC Plus is the cartel that controls about 80% of our world's oil reserves. They account for about 60% of our oil production as of today, right? So what they're looking to do, on top of the 5 million barrels a day in production they've already decreased that are set to expire at the end of the year, they're meeting on Thursday to decide if they're going to extend the production cuts. It's a really big deal when the people that control most of the world's oil supply are deciding to cut production because they're not making any money at $73 a barrel today, at $76 a barrel today. They want crude prices back up. What that means for everybody listening is, if OPEC Plus decide to cut prices on Thursday, cut production on Thursday, they're aiming to drive crude oil back up, which means what we pay at the pump is going to go up. And that's not good news. I mean, diesel, crude, this time last summer, crude was $126 a barrel, $120 a barrel. Diesel was $5.81. Remember? Today it's 76 and 420. So you can explain about 80% of the cost of diesel by crude oil prices. So watching crude prices on the West Texas Intermediate from Cushing, Oklahoma, that's an important data point to watch, because I think that will determine what happens next year. Like if the market goes into a malaise in the first quarter and you still got high operating costs and diesel prices go up, right? You've got this perfect storm where it's going to be really hard to get by. And I don't have a lot of solutions other than you've got to know your operating costs. What I do know is, when I look at DAT rates every week, there's no one home at the average. Like when I say national averages are $1.63, forget that. Right. There is a lot of opportunity in individual markets, right? Rico's got a niche where he is. I know carriers that are pulling for close to $3 a mile. out of the Pacific Northwest. Now you've got to handle ugly Christmas trees and sap and needles and, so, but there is an opportunity out there. You've got to be able to follow where the market's at and be prepared to do something different. I just think this is a really tough market. We've got a lot of capacities, a lot of competition, but overlaid on that is a very flat consumer market and industrial market, and nothing on the horizon that's going to change the fundamental dynamics, because you've got high interest rates, right, that are putting like a boot on single family home building. Like, we just thought we can't build enough homes right now because people aren't moving. They're locked into their existing mortgages. You've got a single family housing crisis. There's a lot more multi-family homes being built, which is a different freight mix. It's a different type of freight.
Yeah.
So, and if you've got fewer single family homes being built, then you've got fewer appliances, less carpet going in dry vans. Single family homes are a really big indicator. For context, we are building more homes than 2018 and 2019 compared to October, but it's still way down compared to last year. And that's what's freshest in everyone's minds, is the boom in single family housing during the pandemic.
Which was great for the flatbed industry as well.
Yeah, if you track single family housing starts and building permits, there was a 90.92 correlation between dry van rates and the number of single family homes being built.
Yeah.
And
which is one of the big things I wanted to highlight Steven's comment to here as well, as he was talking about pays to have a relationship with customers, even if it's a broker. And that's no truer words have been spoken.
Yep.
You got, because relationships, that's the main thing about this business. It's relationship based.
Yep.
And you guys, that's the thing about being able to go out and even attract your own customer.
Yep.
It's a relationship. If you can build a relationship, whether it be a direct shipper or whether it be a broker, even if it's a broker, you can develop a great relationship with a broker and make really good money and do all right for yourself.
Yep.
It's just a matter of being able to fit the need that is out there and being able to service it.
Yep.
The big thing that's coming down the pike, Dean, and I don't know if you've heard much about it as far as on your end, this whole thing about studying and potentially some type of a law about the brokers in detention, about the study for detention.
Yeah, I saw that.
I'm not sure if you're hearing anything on your end and what that may, how that may even affect rates or whatever. Because I personally, I thought that once the ELD mandate became mandatory, that everybody was on ELDs.
Yeah, right.
I personally thought that, hey, that was what we were going to need to have to be able to kind of force the hand to begin to get brokers to start paying up for detention. Right. Because before it was always, well, you need timestamps. Well, if you got a satellite that's tracking a vehicle that can show you that, hey, you've been in a dock for 6 hours, somebody, that doesn't come for free.
It's a bit like the insurance market, right? Where we're heading into a hard market where there's less capacity, so insurance costs are going to go up. Right. So the insurance industry goes through hard and soft markets. Capacity is loose. Shippers will do what they want to do. And it won't be until capacity tightens that we can get their attention. And what I've studied is the amount of time trucks spend on docks by market cycles. And when the market's loose and there's plenty of trucks around, detention times blow out, and then they shorten up when things get tight. The problem, though, Rico, is structural. For some reason, and I don't know who it was that started this, but shippers have an hour and a half to 2 hours free time every load, and that's where the rot starts. So absolutely every minute on a loading dock. I mean, heck, you can put 26 pallets into a van in like 20 minutes if you're half decent on a forklift.
Right.
So it doesn't take the amount of hours it takes. And with warehouses moving more towards robotics, I can see this becoming a really big problem, because the characters that got there loading and unloading now aren't doing a really good job. I can see that getting worse. But if we can, so what this means is, if you're going to go onto a loading dock and go on duty non-driving to record hours, right, then you have to get the detention time. All of that's going to come off your 60, right? So you've got to be compensated for every hour you're on that loading dock. So while ever capacity's loose, it's going to be hard to move the needle. But I totally support the need to do this, because every hour a trucker spends on a dock, it's the opportunity cost is maybe, what are they going to run 60 miles in an hour?
Right.
So that's the problem, is truckers want to drive, not spend time on loading docks. I think the idea, I think large carriers have to step up and say, yeah, for minute one, the clock's ticking. Now, will they do that?
Yeah.
I don't know. They don't want to, they don't want to pay drivers more. Like they're happy to have high driver turnover and lower costs.
I'm not so sure if that's the case, Dean. I'm not sure if they don't want to pay the drivers. I think that people, that the pressure comes from, they don't want to damage the relationship with the shipper. They want to, by all means, they want to try to coddle.
Right.
And maybe that's not the best word to use, is coddle, but they definitely are trying to protect the relationship with the shipper, because
they
it's
don't
hard
want,
enough,
especially in this market. You're right, Rico, because they don't want to upset the shipper, because the shipper's going to say, well, get your truck the hell out of here, because I got 9 guys waiting there that want that same load, and I don't have to deal with you.
Well, you're right. You're right.
Take those 3 skids off your truck that you've been waiting 9 hours for, and get out of here.
That's what happens in the loose market like we've got, because rates have been dropping considerably for probably the best part of last year and well into this year, right, for shippers. So what that tells you is capacity's been loosening. The large carriers have been reducing their rates to keep the volume, right, and not wanting to upset the apple cart. So you're absolutely right. There's so many different parts of this, but I probably spent a third of my life waiting to load and unload with shippers. It's probably the most frustrating part of truck driving, because it's like nobody cares. It's like
and hence that's why we have people that come in, and I always said, if you take someone and you delay them and they miss their wedding anniversary or their kid's birthday, there's a chance that person may decide he doesn't want to do over the road anymore, and he's going to become a city driver if he stays in it.
Bruce makes a really good point, Bruce Jansen there. And he's dead right. The loading part is frustrating and time consuming, but you're right. There's been a lot of times I've bumped a dock and they haven't even thought about pulling the load. Like that was particularly evident during the pandemic when they didn't have a lot of labor. You're pulling in for just in time, food related freight, and they haven't even got around to picking it. Especially, anything to do with warehouses in food and bev tends to be pretty bad.
Yeah, it's very, very, very long waits. Especially grocery warehouse.
We studied at Freightways. We studied a lot of telematics data on trucks and trailers at a dock door level. Right. So we studied how long a lat long plot would sit outside the gate, inside the gate, at a dock door, across 100 dock doors on a DC, and the variation in dwell time at a loading dock was staggering. They weren't all the same, first of all, but there were some that were like 10 times longer than the norm. And it had to do with what Bruce is alluding to, which is there's a systemic blockage in flow on the other side of the dock door. And in some of the cases, it was because the manager's office was just above the dock door in the corner and no one wanted to go there. Anyone who got parked there was just doomed. Little things like that. Yeah, it's a very complex situation. All of these problems we're talking about tend to become bigger issues when things are quiet like this. We like to be busy. We've got less time to think about all this bad stuff that goes on.
Well, because when things are busy, everything flows.
Right.
And when things are busy, it stops.
Dean, you sent me an email, and you were talking in the email, and we kind of touched on it a little bit. I said from my anecdotal point of view that I didn't think that things were going that great, but you say here that there's record consumer spending from the Black Friday weekend and everything.
Yeah.
So let's touch on that. Let's touch on that part.
Yeah, this is sort of a good indicator of consumer confidence. They had just over 200 million people visit retail stores between Black Friday and Cyber Monday. People spent a lot of money, more than last year. So they were worried that we wouldn't go out and spend. And the data shows that it was just over 200.4 million was more than last year's 197 million. There were, and it was a real mix of people buying, online and retail. Black Friday was 76 million in store, 90 million people visited online. Cyber Monday is mostly online. So it was when I listened to the National Retail Federation call this morning at 11 a.m. and they were very pleased with the result that so many people went out and shopped now, and they spent more money this year on average than they did last year. So that
okay,
but I think for what that means for us is a lot of that freight's already been positioned in warehouses.
right.
Some of it will need to be replenished. There's a lot of time to go between now and the end of the year. I think with the amount of inventory that shippers had in warehouses, I suspect there will be a lot of last-minute freight being moved between now and Christmas. I think there'll be a few rush orders. That's what I'm looking for in the spot market anyway.
Yeah, you know what? I hope there's a lot of rush orders, and usually when you have this sort of a year, Christmas isn't great for the trucking industry. That's what I have found.
Right.
And then January and February are just a bust, and you hope that the ice breaks by the time March, April. That's what you hope, unless you're in a real downturn, which we don't know. This
is all going to be. I think we've got to watch interest rates. At a broader macroeconomic level, interest rates are going to be very pivotal. If interest rates start to come down in a meaningful way, that should lift the brakes off, that are on the economy and see more business investment. That's going to be the key, because that's what's holding back a lot of investment right now is higher interest rates.
Well, people are spending so much more on interest on things they've purchased that they bought on credit. And that's a killer.
And also, it's like the float, the amount of money you've got to carry with your debtors. Your overdraft, your bank overdraft is costing you a lot more these days too. That's affecting brokers and carriers equally. Is the cost of capital just to run the business? It's a much bigger cost this time around on top of operating costs.
Well, yeah,
right.
And that's what's killing some of the carriers. It's they're having to pay those overdraft or those charges.
Yep.
They're paying higher interest.
Yeah.
On everything.
Yeah, I was. There was a LinkedIn post a couple of weeks ago. A guy posted a conversation he had with a private equity fund that has an exposure to the transportation industry, and the average fleet size was about 50 to 150 trucks.
Right.
And he said they were very worried because their operating ratios were 103 to 105%. Normally trucking industry operating ratios are in the 95 range. In a typical year. Heartland Express is typically like an 85.
Great operators.
Right. Yeah. So when you start to see 103, 105 operating ratios since the halfway through this year, you say, well, how do they survive that long? That's a great question, and I suspect what most don't know is that group, 50 to 150, is the group that uses the spot market the most.
Right.
Right. It's the small carrier is not the one that uses the spot market the most. The small fleet. And the reason the 50 to 150 is the most likely to use the spot market is because they're too big for their hometown shipper, and they're not big enough to win a big tender from a shipper, a big RFP, right?
Yeah.
They are more likely going to use the spot market because a lot of smaller fleets work from a hometown with a small shipper, and they'll do 8 or 9 outbound loads, and they use the spot market to get home. If you get too big, it's hard for that small shipper to be enough volume for a 50 to 150 truck fleet.
I'm gonna push back a little bit on that, Dean. I think that you got now, especially with social media being as much as it is, and you got a lot of people that have been touting, and I think that's my personal opinion. I think that's where a lot of the influx of people that jumped into trucking because, hey, trucking over the pandemic and everything, trucking became in vogue, kind of. We
For a short period of time. Yes, you're right.
between hey, you can make millions with dispatch services. I even seen somebody on social media had was advertising that, hey, he made over $1 million with a box truck. How in the hell did you?
Well, what did he have in the box truck?
that part too.
Yeah.
That part too. But I think that you got a lot of people that may have, unfortunately, we go jumped in, go for the low hanging fruit, and a lot of people have a tremendous fear of hearing no, of actually going and approaching businesses or shippers and even putting themselves out there to the possibility of getting a yes. The default is always going to be no if you don't go knock on the door, if you don't go and talk to them. And I think that we have a lot of smaller fleets that have relegated themselves to, hey, it's just easier to just jump on the load board.
Well, because that's the low hanging fruit. You're right. What happens when you take the low hanging fruit? Quite often it's rotten.
Right. And so the possibility of which was I think it was Stephen that was talking about earlier, that's what we're talking about with the relationships, which is the thing that we've always kind of touted on especially on this podcast, is being able to go out and develop those relationships. So even if it's a broker, if you got there are some brokers out there that have some really great freight, and if you can manage to develop the relationship with them to get that freight before it ever hits a load board, then you are setting yourself up to where you can make a good living, a good rate per mile, a good consistent freight, and you will be all right. But if you are constantly every other day or every day filling out carrier packets and everything of that nature, and you're going from broker to broker to broker, you are putting yourself in a conundrum. You don't have a designated market in which you're servicing. And I know that a lot of the stuff, it gets to be, it gets to be really tight, because me personally, I have had to take a serious haircut from my shipper recently. But hey, we have to make adjustments and be able to move on the fly. And that's the thing about, controlling the things that you control, making sure that you're trying to get your costs down as low as best you can, and keep those things in perspective.
I just while you were talking, I was looking at our long-term forecast on where rates are likely to be. I don't see in dry van a lot of upward lift. There'll be some, I think, in maybe around April next year, but I think most of it's going to be flat between now and April. So there's not a lot of opportunity, I think, for significant rate increases. In the next little while, it's going to be driven a lot by, how the broader.
Well, because that's again, we're talking low hanging fruit, gentlemen. It's very easy compared to reefer and flatbed to get into dry van.
Right.
So, you know what? It's the people with dry vans that are going to suffer first.
Yeah. And I think the other thing, though, that I was looking at some intermodal rates, shippers are saving about 26% on intermodal contract versus truckload rates.
Yeah, I don't listen. For some things, I think intermodal is top notch. You can't beat it. If you're shipping loads of paper on huge rolls and things like that, it's a great way to ship. If you need your product there in a timely fashion, you're playing Russian roulette with your supply chain.
Of course, yeah.
I've picked up some incredible customers through the years that mistakenly their freight got put on intermodal, not by us, but by another carrier. And here's their freight sitting at a rail siding in Chicago a week later, and it's stuck behind all sorts of other freight. And you pick up a lifelong customer when you pick up those customers for over the road. Yeah.
I was just, how much time we got left here? We get running up on time.
Yeah, we coming up on it,
yeah.
Dean. I appreciate. I apologize for my tardiness once again, but we definitely appreciate when we have you on and allow us to really pick at your brain and get all up in the crevices there, because I know we giving you a workout tonight.
Yeah. Well,
I love having you on. You're just, there's so much great information in there, and it's not somebody's opinion. It's hard data. That's what I love about it.
yeah, but a lot of our rates, a lot of folks don't appreciate it. These are the rates based on what carriers agree to haul loads for. We don't set the rates. We scrub a lot of the highs and lows out and come up with an average on a lane.
Right.
And that's why I look at national averages, and then I break it down every week on my weekly blog post, and I look for where there's opportunities at a regional level. I think that's where carriers have got to focus rather than the national average, so they can expand that margin. Right. Our top 50 lanes, for example, if the national average is $1.63, the top 50 lanes are running at $1.89, 26 cents a mile higher. So, depends where you are as to what the rates are going to be. National averages, though, are very flat. That's sort of the leading indicator, and not a lot of uplift between. There will be some room to move between now and Christmas. I'd be looking beyond Christmas.
Yeah.
It's definitely, I think we are definitely in survival of the fittest mode. We have to, and that's the whole part about being able to control your costs, knowing your costs, understanding that you can't operate. You can average your cost out, but you got to understand you got to be profitable at some point. Somewhere down the line, you got to pay the piper.
Well, yeah, and what's going on, guys? As Dean was alluding to about carriers operating in the red, with operating ratios at 103, 104. What's happening to those carriers now? So I understand from my friends that are in banking, is they're getting forced to put money back in. So they're either taking money, personal money that owners are putting back in, or they're getting financing on assets like real estate. Now, one of the saving graces for a lot of trucking companies is they have great real estate.
Right.
And they're grabbing a mortgage from somebody else on their terminal where they had great equity in, and they're plowing that money back in their business so they stay viable. That's not, you do what you have to do. I understand that, but that means times are tough when people
keep the doors open. Yeah, got to keep the doors open. Well, Dean, let the good people know where they can find you. Of course, they should know you can find Dean's great work over at DAT, and of course, we try to get them. We try to steal them from DAT every now as often as we can. Get them over here to give it to share some knowledge with us. But go ahead, Dean. Let the people know how they can find you and where they can.
We have every Tuesday 10 a.m. DAT Freight and Analytics. We have a live show on every Tuesday morning. I publish a blog post around this time on a Tuesday evening. It's got all the charts and all the economic commentary, so you can follow all of our load to truck ratios. Just go to dat.com/market update. I'm on LinkedIn. You can find me there, and of course at the Grumpy Pete on all the social media platforms if you want to look at some pretty fancy trucks.
Really fancy.
All right. All right. Well, Dean, we appreciate it again. Thank you. I apologize for my tardiness. Chuck, let the good people know how they can find you.
If anybody needs me, send me a quick email with your phone number to chucksnow280@outlook.com. And with that, Rico, I will let you back. We're in a hole for another week. And Dean, thanks again for joining us. It's a delight. And we'll have you on again in the new year.
Yeah, absolutely. Look forward to it.
We look forward to it.
Well, ladies and gentlemen, we want to thank you guys for taking the time out to join us, whether you listen to us live and were social with us and chatting back and forth. We greatly appreciate you doing so. Please tell a friend to tell a friend about the show. Like, share, and subscribe. Hit the little bell icon if you're watching us on YouTube. Puts us into a broader algorithm. If you would do that for us, it's free to do that. As always, it helps us get out to a broader audience. We're trying to grow the show, so we appreciate your help if you would do so, if you would be so kind in doing so. And with that being said, ladies and gentlemen, stay safe out there, stay healthy. I'm even gonna steal one from Kevin Rutherford. Stay profitable.
Very important.
Stay profitable and keep it in between the mustard and the mayonnaise. Until next time, ladies and gentlemen, God bless you and good night.
See you guys.
Catch on the flip-flop.